Hello, welcome back to FX Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. If this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the bell notifications so you get notified each time I upload a new content. Try to like and refer this channel to your network so that YouTube pushes to a high level of audience. In today's video, I'm gonna teach you something that a lot of traders have failed to take note of, and these have kept them losing with a very big negative status quo edge. And so in this video we're gonna treat this problem, and the topic is entry error analysis, EEA in Forex synthetic market. Entry error analysis, EEA in Forex synthetic market. Okay, now I'm gonna read this document and also make more research on the internet to show you what error analysis means. Okay, pretty much we'll be discussing error analysis as a function of price without paying much attention to time, but at the advanced level, which is beyond the scope of this topic, at advanced level, the error analysis in the Forex synthetic market in the financial industry should be a function of time and other variables like fundamentals and sentimentals and other factors that influences price movement in the financial industry. So I'm gonna read this. When a trader enters a buy or sell position, that entry can either hit take profit or stop loss, or just remain neutral, that is ranging, right? So we continue reading. Our aim or our objective is to minimize error in the error functions. So percentage entry error, EE, is entry error over actual entry price times 100%. Okay, this formula is going to be used for this analysis. Okay, most time you can assume a certain percentage entry error so that you can use it to optimize your risk reward and get the best sniper entry. Okay, where entry error is late entry price minus actual entry price. This actual entry price is very hard to get probabilistically and statistically. If it is easy to get, it means that no one will lose money once you know the direction of the market and you're able to get the actual entry. An actual entry is an entry whose drawdown is 0, whose error is 0. So when the late entry price is equal to the actual entry price, the error is automatically 0, and you are 100% accurate, because that is relationship between error and accuracy. When error is 0, then accuracy is 100%. So error is inversely proportional to accuracy, right? So you have to take note of this. If we made EE to near 0, then we have sniper entry. So we have another type of error, SLL, stop loss error. This is amount of drawdown the market have if price tends to go more than 50% of SL limit. Now SL limit is a kind of the difference between the entry price and the stop loss price. So if market draws down 50% of the SL pip, let's put pip here, SL pip limit, then we say that there is stop loss error. Okay, let's assume your stop loss pip is 12 pip, and the market draws down by 7 pip, which is more than midpoint or half of 12 pip. Then the SL error is activated automatically and is not proper, it's not good. your SL error should not go beyond 50%. If it goes beyond 50%, you are gonna receive margin call, and there's probability of this SL getting triggered, and you will be taken out of the market and you lose your money, right? If SL error is equals to entry error is equals to 0%, we then have what we call super sniper entry, and that is where you can actually risk 100% of margin. You can go full margin at this point because there is no error. Both stop loss error and entry error are zero. Stop loss error and entry error are different phenomena, but when they are equal to zero, you will now have what we call super sniper entry. Okay, so right now I'm going to take you to the internet and we'll check more of this stuff. Okay, now what is error term? So in this case, the error term is still the same thing as error function, right? An error function or term is a residual variable produced by a statistical or mathematical model, which is created when the model does not fully represent the actual relationship between independent variables and dependent variables. Okay, so here the dependent variable is price, the independent variable is time. Okay, yes, it's time. A mass psychology, because an independent variable is just like something that is produced by God, something that is produced by nature, something that is produced by something that exists on its own. Okay, something that exists on its own. So we can say that mass psychology is an independent variable because it doesn't depend on anything. Any human being can start behaving with its natural resonance without being influenced by another variable. That's mass psychology. So the mass psychology and time, they are independent variable. Why the dependent variable is price? Price depends on time and mass psychology to change, right? As a result of this incomplete relationship, the error function is amount at which the equation, okay, that is the correlation equation, may differ during empirical analysis. The error time is also known as the residual disturbance remainder time, and it is variously represented in models by letter E, epsilon, and U. Okay, now they are actually trying to explain this error function in algebraic form, so that high level rigid calculus analysis can be applied on it, instead of actually studying it as a numerical entity. It is being studied as a algebraic entity. Now we don't need to go this far, but at least you have to appreciate that these are very, very necessary in financial industry. So right here, when you open trading broker, when you log into a broker, you start using trading platform like MT5, you are an observer. You don't even need to open the candlestick charts or any other form of chart. When you see the quotes, the assets, and the bid and ask price, like the buy and sell price, the current buy and sell price, you are an observer. Okay, you now being an observer, you are trying to say, okay, standing on volatility 75 index, the current price right now is 84,684.94. Okay, now you are an observer. Now you are being disturbed by these errors. You cannot accurately predict the value of the price after 5 minutes. or you may accurately predict the value of the price after 5 minutes. Your ability to predict the value of the price, even if the value is not exact value, but you're able to predict the value of the price so in such a way that the error between the predicted value and the actual value that will actually happen based on the server that controls the market, if this error is very close to zero, that means that you are very, very super smart as a trader. You are very, very, like, not even smart. Your method, your mathematical principle of understanding price behavior is accurate, right? But the truth is, in the long run, statistically, probabilistically, people like traders find it very, very hard to have zero error in observing price and telling the future of the price. They find it difficult to have zero error, meaning that there are measurable errors, and if this error approaches 100%, that means you are a perpetual loser in the Forex synthetic market. You keep losing money. Okay, though the error analysis does not guarantee that your take profit will be hit. Okay, it left for you to deploy high-level calculus analysis to know where your take profit should be, because in market you deal with calculus parameters like critical point, inflection point. So your ability to know those critical points like minimum and maximum points and inflection point, you will be able to control your take profit. And at this point, the rate of change of price with respect to time is zero. At the second derivative of price with respect to time at inflection point will not be equal to zero, but it can be negative or positive. It's left for you to understand all of this, but I don't want to go deep because this is beyond the scope of this content. And right now I'm going to open volatility 75 index so that we start doing error analysis, EEA. Right now I really need to be on my entry time frame because I don't want to do top-down analysis. I really want to get the right entry. I can also refer to the price actions in the past and see in how many ways should we have actually predicted the market with zero error, with lesser error. Right now, this vertical axis represent the price values, and the horizontal axis represent the time value. The mass psychology and other independent variables are not visible here, but you can see their effect on the candlestick. All these wicks, the length, they have different lengths, and the body of candle, you see they are different. All these differentials actually arise due to mass psychology and other independent variables that happen in the market, like sentiment, okay, or brokers manipulation. Right, these are natural. Only our price is independent, is dependent. These are natural and independent. Right now, let's start with what has happened in the past in our entry time frame. I will start by trying to just get a straight line. Now this straight line is a kind of a boundary that represents the price movement, meaning that outside this straight line, I will not calculate where do I see the most candles. So I'm seeing the most candle upside, right? Meaning that below this line, we don't know the equation of this line, but we know that the slope of this line is positive. I remember in elementary mathematics and even some high school mathematics, the equation of a straight line is equals to MS plus C. Now, in the case of Forex markets, Y will be represented as P and M with constant, which is the slope of the line, and S will be represented with T, which is the time, and C is the intercept. Okay, C is the value of the price at initial time of 0, right? That's good. But in most cases, since price since it depends on what you as an observer, what you observe, you can actually take your 0 time to be at any point on the chart, and you can be able to calculate such price, right? So we can actually take here to be our starting point. So that is the price here is our C. Okay, we'll track it back to the as. So here the time is 0 and we start. So immediately we start, the price move from, let's mark that price, it moved from here, which is 82,770, and it flies. I don't care what happened in between, but all I know is that it flies and gets to a critical point where it will create a high and reverse, and it automatically reverse and come. So the belief is that if it is reversing and as it approaches this trend line, there is probability and the statistical confidence that this market will buy. Okay, but the problem here is, in how many ways can we enter this market at exactly this price? This is the lowest, this is the best price, this is the cheapest price. When you are pricing an asset, in how many ways can you price the cheapest price? Like when you price the market at cheapest price, that means there is no other price lower than that price. Okay, the same thing happen when you are pricing asset as somebody, as a trader that want to sell the asset. You are looking for highest price, and this highest price, there is no other price higher than that price. Okay, the problem is it is very hard to get the highest price that does not have another highest price, and to get the lowest price that doesn't have another lowest price is very hard. But if you have the skill to get it, your error bound will be 0. You will have 0% error, and your entry will be sniper, and you are going to have, like, you are going to use full margin, and you are not going to experience drawdown, because there is no way you can experience drawdown like a loss. There is no way you can experience loss if you enter this market here. The market will just fly. Even if it comes back, it fly again until it reach the maximum critical point, until you reach the highest critical point and start going down, right? So the essence of bringing error analysis is when you assume certain error. So you have to, error analysis will actually help you to put drawdown into consideration. Most time you don't need to calculate the error, but you assume it. So you can assume an error of 1%. Okay, if there will be an error of 1% on this price, look at the price. The price is 82,939. So if there will be error of 1%, it means that there is probability of the market drawing down by 829%. Now, you have to run practical analysis. You have to constantly knowing where you wanted to enter the market and measuring the drawdown after you have entered that market and calculating the percentage errors. If you calculate these errors with time, you will not be able to know your error characteristics. You as a human being, you know your error characteristics, how much you can be accurate or not. So if your error characteristics is about 2%, you will actually know that your stop loss should be 2% down of the current price, right? So I don't want to go deep into this, but this thing is necessary this thing is necessary. The other stuff you have to learn in trading for you to succeed. The thing is, if you are still losing money trading this market, if you are still losing money trading forex market, if you are still losing money trading synthetic market, we have many groups, up to 4 to 5 groups. We have one for forex and synthetic markets. Like forex and synthetic signals are shared in one group. We have one for boom and crash asset. Signals of boom and crash are shared in a separate group. Then we have one for gold and US30 on Nasdaq. Gold and US30 and our Nasdaq are shared in one group. Then we'll have one for binary options where we share like the multiplier market in the derivative company is being shared in one group, and rise and fall market in the derivative company is being shared in one group. What you need to succeed as a trader is focus. You don't need to trade all assets, just focus on one. So come into the DM in our Telegram and then select the group you want to join, and you see how you will progress as a trader. Okay, because our signal is where synthesize, sniper, massive risk reward. The truth is that, how do you feel when you lose in 3 goals and then you blew your account, you deposit, you blew again, you keep doing the same thing from time to time? Like, why not use 1% of all the money you would have lost? Take for instance, you have a $20,000 account. You should have lost $20,000 account, because you should plan who you are. If who you are is not enough to fight the market, then fuck who you are and get the real successor in the market for you to succeed, right? So what you need to do is just take some percentage, lower percentage, like 10%. Let's forget 1%, let's consider 10%. Like, you can actually deploy 10% of your total losses that you should have lost and use it to invest in developing yourself or having access to third-party successful resources. You have to leverage the effort of others for you to go far. Okay, so I don't have much. Thank you and bye for now.